This is Kevin Zhao, your finance professor at MTSU. In this video, I will introduce an option pricing model in evaluating distressed company, and this is covered in chapter 23, valuing equity in distressed firm as an option. Okay, previously what we used for valuing a stock is based on cash flows or valuation multiples, but even valuation multiples has something to do with the fundamentals of a company. So previous method is based on cash flows, and we discount future cash flows to come up with stock estimated price. And in chapter 23, I'm going to introduce a very fancy method evaluating stock, and here we look at its option value. Right? And previously you learned Black-Scholes formula or binomial tree option valuation methods in your investment classes. And you might think option valuation model is only for valuing a stock option or other type of option, but in this chapter you will learn that we can utilize option pricing model to price an equity. Reason that we can utilize option to evaluate an equity is because when you look at the structure of a company regarding the mix of debt and equity, actually you can view an equity as an option to liquidate the company. So let's say the company is in healthy condition. Equity is a positive number. Total assets, total value of the company is greater than total value of the debt. So if this is the case, company doesn't need to liquidate, and equity value equals firm value minus the value of debt. But in case that the firm value declines towards zero, even goes beyond zero. Let's say the net asset value declined to negative number for equity, where total value of firm is less than total value of debt. In this case, the corporation is in the shape of bankruptcy, and in a bankruptcy, the value of equity will not decline to a negative number because as a limited liability companies, the value of equity, the minimum value of equity is zero. It cannot go negative. So in this case, the equity value acts like a call option. Right? When equity value is positive, then the value of equity equals the difference between firm value and firm value minus value of debt. But when firm value declines to a level lower than the debt, then the equity value will decline, but it will not go negative. It's zero. So the payoff of an equity is pretty much like the payoff of a call option. I think when you look at the equation here, you will see very clearly that equity can be viewed as a call option. Let's take a look at a call option first. And here, S is the stock price, and K is the strike price for this call option. If stock price is greater than the strike price, if S is greater than K, then the payoff of this call option equals the difference between stock price and the strike price, or S minus K. That's payoff on this call option, or intrinsic value. But if stock price decline to a level that is below the strike price, then intrinsic value will decline to zero. Although you say, hey, if I exercise this call option, the intrinsic value is negative, right? But since minus K is negative, then option holder doesn't have to exercise this option, and they can just forego the option, and option value simply decline to zero. It cannot go negative. Right? So that's the nature of a call option. Now let's take a look at the first half of this slide. The payoff to equity on liquidation date equals the value of firm minus value of debt. Right? So this is a positive item if value of firm is greater than debt, and the difference is the value of equity. Right? But in case that value declines below the value of debt, okay, if you take V minus D, that's negative. That's negative. But in terms of the active value in the corporation, it cannot go negative. The minimum value for equity is 0 in case of bankruptcy. So when you compare those two scenarios, you see that equity is pretty much like a call option. And this picture showed you the payoff of equity regarding this liquidation choice. On the x-axis, that's the value of firm, and in the middle, that's the face value of debt. If value of firm is greater than face value of debt, the equity value is positive. But when value of firm declines, even when value of declines, then the value of equity will decline. However, equity value cannot go beyond 0. On the negative side. So here you see a very typical payoff of an equity that is pretty much like a payoff of a call option. And in the context of call option, this value of firm is pretty much like a stock price, and this face value of debt is pretty much like the strike price of a call option. Okay, now let's look at one example to see how we can utilize option pricing model to price an equity, especially when company is in distressed condition. Let's assume that you have a company where total assets is valued at $100 million. That's firm value, market value of the firm, which includes the value of equity and the value of debt. The standard deviation of this asset value is 40%, which means in the future this company could perform better or perform worse, and standard deviation is pretty significant at 40%, which means it may increase by 40% or decline by 40% in the future. Let's assume that face value of debt is $80 million, and this is zero coupon bond with 10 years left to maturity, and the 10-year Treasury bond rate is 10%, which indicates that risk-free rate is 10% in this case. This is just assumption. Now, I'm going to show you the Excel spreadsheet how we can utilize option pricing model to deal with this specific problem. And once again, the firm value is $100 million, and in the context of call options, pretty much like a stock price. But here it's the value of the firm in the context of equity valuation. And the exercise price of K, or the face value of outstanding debt in this case, this face value of outstanding debt pretty much like exercise price of strike price in a call option, which is $80 million. And the life of the option equals the life of this debt, which is 10 years. So this is a pretty long time period for an option, because for stock options, typically short-term options, 3 months, 9 months, and the longest option that you could find on the market is just 2 years. But this equity actually looks like a long-term option with 10 years of life left. And the variance is a square of the standard deviation. Since standard deviation is 40%, therefore the variance, or the square of standard deviation, is 16%, and the risk-free rate is 10% in this case. Now, I'm going to show you the Excel spreadsheet that I developed here. Let me make this a little bigger. Okay, on the right on this picture you see the very famous Black-Scholes formula, and it says CC means call option price. Call option price equals S0 times ND1 minus K times E minus RT times ND2. So S0 is stock price and this K is the strike price of the option. And you have this E raised power minus RT. This is a discount factor where we do continuous discounting in order to calculate the present value of the strike price. And the both stop price and then the present value of strike price carries two probability terms, ND1 and ND2. And actually ND1 is also called delta in the option pricing literature. And also it indicates the probability that option may be in the money in the future. That's ND1. And the D1 follows a pretty complicated equation, but here you see there are four factors determining the value of D1 and D2, and four actually 1, 2, 3, 4. Yeah, four factors. The first one is stock price S0. Second one is the strike price. And the third one is the risk-free rate R. And the fourth one is standard deviation. And the fifth one is T. T is time left in an option. Actually, it's the five factors determining D1 and D2. And the ND1 and D2 are cumulative probability based on D1 and D2. So here, let's take a look at a spreadsheet, and this is the spreadsheet that I developed for you to estimate the value of the equity. And on the left column, you see the variables are defined within the context of a call option. S0 is stock price, K is the strike price. Let me make this a little bigger. This S0 stock price, K is strike price, and the standard deviation measure the volatility of the stock return and the risk-free rate as well as time t. So that's variables, five variables in the context of option valuation. Now let's take a look at the variables in the context of valuing an equity by using option pricing model. And the first one, this stock price, pretty much like a value of the firm, and strike price, it's pretty much like the face value of the debt. And here standard deviation is standard deviation of the firm value, and risk-free rate is the same, and duration of the debt equals the time left in an option. So we have five factors here, five variables here for you to estimate equity value. Now let's take a look at the previous example. In the previous example, value of firm is 100 million US dollars. So this is the input. And the face value of debt is 80 million US dollars, and standard deviation 48%, risk-free rate 10%. The duration of the debt equals 10 years. And here I follow this equation to calculate the D1 and the D2 according to Black-Scholes formula. D1 equals log function of S0 divided by K, S0 divided by K, plus R, which is the risk-free rate, plus square of standard deviation divided by 2, then multiply this with T and divided by standard deviation times square root of T. So here in this cell, in this D1 cell, you see the formula that I used based on Black-Scholes formula. And the D2 also follows what you see on the right, which is equal to D1 minus standard deviation times square root of T. So once you have D1 and the D2, it's time for you to calculate ND1 and D2. And I use the norms dist function in Excel spreadsheet to calculate cumulative probability distribution based on D1 and D2. So this norms norms this normal distribution. I think that's norms distribution. Yeah. to calculate ND1 and D2. Then I put everything together. The call option price equals stop price times ND1 minus the present value of strike price multiplied by ND2. So here, this spreadsheet is based on Black-Scholes formula, right? And that is equity value. Equity value in this case equals a little over 75 million US dollars. So when you take a look at the face value, I mean the value of firm is 100 million dollars. Face value of that is 80. You say if you look at the face value of that, you would say, hey, equity value is about 20 million US dollars, right? But actually, the market value of the debt is much lower in this case because company is in distressed condition. It's highly leveraged, and the equity value is much higher than 20 million dollars. And actually, equity value is about 76 million US dollars. And the debt value actually is only 24 million US dollars. Although face value of the debt is 80 million US dollars. So here you see a wealth transfer effect in a firm where debt holders may be taken advantage by shareholders, especially in a company that has high volatility, because when company gets better, then there will be more added value on the equity side, and the debt actually serves as cushion for equity in a volatile business environment. So this actually showed you that equity value is very different from its book value that you thought of. And previously you thought equity value is 20, but actually it's 75.94. So this is how you use Black-Scholes formula, option pricing formula, to estimate this equity value. Okay, now let's go back to the slides. And based on $24 million worth of debt, you can figure out what's the current year to maturity on the debt. If it's a zero coupon bond, the face value $80 million, current value is only 24. Therefore, the year to maturity on this zero coupon bond, 10-year coupon bond, is about 12.77%. Now, let's say that the situation of the company is getting even worse, and the firm value declined by 50% or 50 million US dollars. Previously, it's 100 million US dollars. And right now, it drops to 50 million US dollars. The face value of the debt remains at 80 million US dollars. So the question is, what will happen to the equity value of this company? I mean, previously equity value was 75.94 million US dollars, right? And if value dropped by 50 million US dollars, you would say, hey, it could be that equity value would decline to 25.94 million US dollars because 50 million US dollars value has been gone, right? And that's your guess, but actually what will happen in the real world is very odd, because you will see that equity value will decline much less than 50 million US dollars. And in this case, when firm value declines, the debt holder will take certain burden from this financial losses from the company, and actually the value decline in equity will be much less than what you think of. But how much that the value of equity will decline based on $50 million decline from value? Well, let's use spreadsheet to do a little calculation here. And I copied the spreadsheet here, but just show you that, okay, when value of firm declined by 50 million US dollars to 50 million US dollars, and face value of debt is 80 million US dollars, I mean, technically this company is in bankruptcy. However, since this debt hasn't expired yet, you see that liability will only come in 10 years. So this company can continue to operate for the next 10 years, right? So if this is the case, given 40% of standard deviation, 10% risk-free rate, and 10 years of duration of the debt, I can calculate D1, D2, and D1 and D2, right? And to come up with the equity value in this case, which is a little over 30 million US dollars. Previously, I mean, you thought equity value may decline by 50 million dollars to 25, but actually it declined less than that. Why? Because debt holders also take the hit. Previously, debt value was 24 million, and right now it's 19.59 million dollars. So from this option pricing formula solution of the equity value, you see that there is a wealth transfer effect between shareholders and debt holders. And the option value of equity in a distressed firm is came from the losses from debt holders. It's like equity holders hijack the debt holders. And as long as firm operation remains volatile or uncertain, equity or stockholders can capture some values from debt holders. So that's a very interesting dynamics. So even in a company that you think is technically in bankruptcy shape, the equity value is not zero as long as the debt is not going to be expired. I mean, in this case, if debt is going to expire in 10 years, then there's 10 years to wait for equity holders, right? To see if there's anything good could happen because the volatility is pretty high in this case, 40% a year. So there's a chance that the equity value can go positive or even higher. So that's a time value of an option, right? Time value of an option. And the debt holder here has to sacrifice to compensate for equity holders. So this is very, very dynamic, very interesting dynamic because from traditional view, from cash flow, from the view of cash flows, when firm value declines below the debt value, you would say, hey, this company is in bankruptcy condition, and the value of equity will definitely decline to zero, right? But interestingly, in most cases, they are not zero, and you can see some real cases in the market. As long as the company hasn't reached the final stage of bankruptcy, the equity can still be traded on the market, and equity value may not be zero. And in some extreme cases, the equity value may increase during the bankruptcy process, because in some cases, a company may survive from reorganization from the bankruptcy process. In that case, if company survives, then the value of equity will actually increase tremendously. Okay, this is a continuation of the previous example. Yeah. An equity value persists even when firm situation getting worse and worse. And from this table, you see from this picture, you see that when value of company diminishes, given 80 million face value of debt, the equity value remain positive for a long time. And even when value of firm declines to $10 million, I mean, equity value still remains. So equity value persists as long as the debt is not expired yet. And here it's 10-year life for the debt. Therefore, it's a long-term option. A long-term option, of course, worth a lot of money. And then here are the more details how you can utilize this option pricing model to assist your valuation of equity, especially in a distressed firm, right? And a distressed firm, of course, have significant amount of debt outstanding, right? And distressed firm typically will have low firm value, which is close to the book value of the debt, or even lower than book value of the debt. In that case, equity value persists as long as company hasn't go bankrupt yet. So that's yeah, this table offers you some technical details regarding some key variables that you put in this option pricing formula to calculate option value. And I will demonstrate one example to see how you can do a more complicated problem here. Alright, so here's a problem. On the right is the Black-Scholes option pricing formula. And on the left, you have three tables. The first table is to calculate the fair value of the company. And on the lower right, that is the table where I calculate standard deviation of the firm. And on the left, it's an option pricing formula where I come up with equity value estimation. Right? So in this case, in the year 0, the EBIT of the company is $850,000, and the tax rate is 40%. Therefore, after tax EBIT equals EBIT times 1 minus 40%. And let's assume that net capex is 100 million is $100,000. And once you get that, you can get a free cash flow to the firm in year 0. And let's say we assume that the growth rate will be 20% for this company for the next 5 years. High growth time period, 5 year, high growth, 20% increase for EBIT as well as net capex. And then we can calculate free cash flows for the next 5 years. Right? You see everything increased by 20%. Net capex increased by 20% as well, just assumptions. And here we can calculate a free cash flow to the firm. And in the 6th year, that's the beginning year of the terminal time period, growth rate declined to 5%, and net capex growth will decline to 5% as well. And that's the free cash flow in the 6th year. Okay, once we get those free cash flows, we do discounting. First of all, we get present values of first 5 free cash flow during the first 5 years, and then we calculate terminal value based on constant growth model, and this is already discounted. It's present value of the terminal value, and then I add those present values together to get firm value or enterprise value. In this case, cash value of firm is 0, therefore enterprise value is equivalent to firm value. So get a firm value number here. It's about it's a little less than 16 million US dollars. Right? So this is a first input, pretty much like a stock price in an option pricing model. And this company has $10 million outstanding, so that's face value of the debt. And in this case, value of firm is greater than face value of debt, so this company is not in very distressed condition, right? It's a pretty normal company, and the standard deviation is unknown because in the question I only know the standard deviation of equity and the standard deviation of debt. And here I can figure out the weight of equity, which is firm value minus debt value. That is equity value divided by the firm value. That will give you the weight on the equity, and then weight of the debt, as well as correlation coefficient between equity and debt, which is a 0.5. This is from the question, and then I incorporate those 5 factors, 5 variables to calculate standard deviation of the firm. This is a pretty complicated equation. Standard deviation of firm equals standard deviation of equity square times weight of equity square, then plus the standard deviation of debt take square times the square of weight of the debt. And then you have a third item here, 2 times standard deviation of equity, standard deviation of debt, weight of equity, weight of debt, and 0.5. So everything in this parenthesis give you the variance of the firm, but here I need a standard deviation. That's why I take square root. I take square root to get the standard deviation of the firm, which is around 20% here. So here I got the third variable here, standard deviation of the firm. And then assuming 5% risk-free rate and the duration of the debt is 3 years, then I can calculate D1, D2, and D1 and D2. Then I plug everything into Black-Scholes formula to get that's 7.4 million US dollars worth of equity value in this case. Right. So this showed you a very a lot of details how to estimate equity value based on option pricing formula, and also incorporates two-stage model in estimating firm value, because the firm value is something that you need to put in this Black-Scholes option pricing formula. Right. So to conclude, I would say that option pricing formula give us a new perspective in valuing equity, and option pricing theory was a path-breaking research back to 1990s. Dr. Scholes and Dr. Merton won Nobel Prizes due to their contribution to the option pricing theory, right, in 1997. And people say, hey, those two researchers are very smart, and actually there are more people contribute to this option pricing theory, including Dr. Black and many others. The reason why this option pricing theory can get attention from Nobel Prize Academy, because this option pricing theory is not just about option pricing. And now you see that we can use option pricing theory to deal with equity value in a firm. And in a more wide context, I would say option pricing principle can be used to evaluate any assets in this world, not just options. It can be a bond, it can be a stock, it can be a commodity, it can be real estate, it can be anything. It can be futures contract, it can be swap, it can be everything. Because when you look at the fundamentals of the financial market, you would say that the key point of all financial assets or financial instruments is just one thing. That is risk or uncertainty. Right? And this option pricing method and actually focus on this riskiness of financial assets. An option price is just the price of risk or price of uncertainty. So when you consider the uncertainty of financial assets, then this option pricing model can be applied to everywhere and any assets. And previously, equity investors use cash flow based model to come up with stock evaluation, and in some unique scenarios such as distressed firm, they may overlook the option value of the equity. They see the cash value of equity decline to zero, but in some cases, as long as company has large amount of debt, or if there's any chance the company may survive due to too big to fail argument, then the equity value may persist. And actually, equity value can even go higher when volatility of the company increase in the future. So the dynamic here is very interesting. The equity holder actually hijack debt holder when company is in distressed condition, and equity holder actually can capture some value from debt holders. That's why option value of an equity persists even when company is in distressed condition. So as long as company is not bankrupt, the equity value will not decline to zero. So that's what we learned from this chapter. And in the future, I think if you look at those distressed companies, sometimes you will see that distressed company value are declining towards zero, right? Towards zero. But at a certain point, you will see the option value of those distressed assets uh, can can be discovered if it's lower than what you calculate from this option pricing model. So this concludes the chapter of using option to value distressed equity. I hope you enjoyed this video, and I'm always here helping you to achieve your not financial but the academic success in this class. And I think the skill that you learn in this class can help you to achieve your financial success, right? And when you spend a lot of time working on those exam questions, I mean, you have a lot of details to address. And during the class, actually, we developed a huge toolbox where you could use many different tools to deal with certain issues for certain aspect of the stock valuation. But I think all your hard work would be paid off. Right? And here, what you can get from this class, I would say it's kind of threefold. First of all, you should achieve academic success in this class. Of course, this is the least that you can get. And the second, you could acquire necessary skills for you to work as a financial analyst for a corporation or investment bank. Right? And the third thing here is this class offers you not only skills but perspectives and training experiences to be successful not only professionally but also financially as well. So for your valuation project, I wanted to remind you that the serious research that we've done for any valuation, for any stock that you're interested, may generate a significant amount of value. Right? And for example, before you learn this option valuation method for equity, have you even think about a company that's going to go bankrupt still have option value left? Right? So if market take cash value as I mean, if a company is going through a difficult time and the market actually take cash value as stock price, then if you found the actual value from option pricing model, then you're getting so-called uh, research value. Research value from studying certain stock valuations. So this class, I would say, hey, your success will be based on three things. First one is your academic success, right? A good grade, A or B plus, right? And typically, most people in this class will get B plus or A, but that's the least you can get. And the second thing is, well, you have a big toolbox. You look like professionals, and it's time for you to, yeah, apply for those financial analyst positions, and you could be a very competent financial analyst. That's your career success. And the third one is your financial success. If you could generate value of research based on professional work that we've been done in this class, and you can apply the same principle in the future for your future investments. So I hope you enjoyed this video. I see you next week when you present your valuation project. And also we have one last chapter left. I would like to use that chapter to summarize the entire class. And also the last chapter will demonstrate how financial people contribute to this human society by creating value. Thank you so very much.